Welcome to another weekly Market Insight. I'm joined today by Chris, one of the analysts at the investment committee, and who isn't here is John. He's headed down to Florida. He actually made it down south before the geese did, so that's John. We miss you, John, and good luck down in Florida. But Chris will be joining us most weeks, and Chris, I'm happy you're here and happy you're joining us.
Yeah, great to be here for the next few weeks, maybe next couple months.
Absolutely. So let's just jump right into it. So we have just passed the 50th anniversary of the going off or removing the last part of the gold standard. In 1971, August 15th, President Nixon, interrupted the show Bonanza with a presidential announcement. And one of the ironies, I believe, is Bonanza, if you look up the history of the word, actually comes from finding a gold mine or a silver mine that was highly, highly productive. So it was the most viewed, what do you call those?
Presidential address?
No, the TV
show,
series, right?
okay.
Now we just talked binge watching on Netflix. But that was the most viewed show on NBC was Bonanza. So there were two other shows that were also interrupted. But President Nixon spent time explaining why we were leaving the gold standard. So up until that point, governments could churn $35 into the U.S. Treasury and receive an ounce of gold back. But the crisis really wasn't there. It had started before. So what had happened prior to that? Well, I think we got to go all the way back to 1913. And this was actually out of a crisis as well, but we created the Federal Reserve Act in 1913. President Woodrow Wilson signed that into power. And really there was a bimetallism that was causing issues. And we were trying to move the management of money from gold, which constitutionally the Constitution defined gold as, or the dollar as a defined weight of gold, and then put a ratio to silver. And that ratio was really being messed with because the market rate, or what you would pay for silver versus gold, was actually changing as silver was becoming unmonetized. So this was a crisis, and then they moved the management of money supply to the Federal Reserve Act with that, with the 13th Amendment, I believe. And then we cover the 1920s in a different video on how we think it resembles the current situation where there was an inflation of the money supply, but we were not seeing a lot of change in the basket price of goods. And the 1933 Act signed by President Roosevelt removed the ability for individuals or citizens to what they would use at the time hoard gold or have gold coins. So they pulled that back. You got $20 for each ounce of gold that you turned in. And then they quickly moved the price of gold up to $35 an ounce after everyone had turned that in.
So how did the pricing of gold work at that time? And now you can go look at the futures market or look at GLD and see what gold's being priced at. But at that time, the government's giving you a dollar to gold price for you. How was the market pricing that?
So what was going on at this point, really it was a pound system. So the British pound was really the reserve currency. And they were having problems with gold flowing out of England to the U.S. And there was all kinds of mismatches. There was a market price for gold, but it tended to be pretty close. But we can see that it definitely changed to the 20s because all of a sudden the dollar goes from $20 to $35 in price of gold, showing that there was inflation of the money supply. But there was an exchange in London that really was where most of gold was traded, and that spot price was determined. But because the ratio or the currencies were pretty much pegged to themselves, there would be a devaluation at times. The price of gold and the price in currencies usually were pretty close. So then we go through World War II, and at the end of World War II, the U.S. is really dominant. They now have most of the gold in the world, and we get into the Bretton Woods Agreement. And this was really a joint venture between the United Kingdom and the United States on creating this monetary scheme known as Bretton Woods, where the U.S. would be the reserve currency. So everything would be traded in dollars and kind of pegged to the U.S. dollar. And if the U.S. was to inflate their money supply or abuse that, the international banks could return dollars for gold coins.
What year is this?
This would be 1945 for the Bretton Woods Agreement. This was in New Hampshire at a resort, and they had put this together. Keynes was there. I think there were a couple of other people that are well-known names that were part of this as they really put together the Bretton Woods Agreement. Now there was a lot of coming out of World War II, U.S. is also the only economy that really wasn't destroyed in the war. So it took some time for the rest of the global economy to really ramp up. And that matters because the trade that happens is really how gold flows. And then we get into the 1950s and really the 1960s, where there was this understanding of guns versus butter. So there was a trade-off. Government spending could be done towards military spending, or you could do domestic spending. And when we get into, especially Lyndon Johnson, we have large military spending. We get the Vietnam War. And we also have a large domestic spending through the Great Society. So it was guns versus butter. And it was assumed that there was a trade-off, but they said, let's ignore the trade-off. There's no real trade-off. We can spend both and just grow our ways out of that. Now, one of the clever things that a lot of people would mention, this guns and butter, is like, why ever invest anything in butter? Just invest in guns, and you can just take all the butter. And I would say that was the Soviet Union's strategy, where it was a very military dependent economy, and then they would go in and invade and take over different regions to try to take the butter that was in the different regions. So it's always a joke that I remember. But when you do both, really when you do anything, when you expand the money supply, what will happen is the price of goods are going to go up. So we already were seeing inflation pop up from these guns and butter type of approach. And we start to get gas lines eventually, but the inflation was already there. So the last check on inflation was really that you couldn't expand dollars more than gold, because if you expanded too much, they end up in international banks because of trade. Things become more expensive here in the U.S., then people begin to spend more elsewhere, and those dollars begin to come back. And international banks are quite aware of it, and it was France as well as the United Kingdom that started redeeming significant amounts of gold back to their banking system, and that caused a problem for President Nixon. Now, there were two options that he had. He could cut his spending and or raise taxes, and basically what that would have done was pull all the excess dollars that were expanded relative to the gold supply in the U.S., but that would mean a recession, or probably a depression. And Richard Nixon wants to be reelected, so this is not an option for him. So then the other option, if what's preventing the government from continuing its spending is the gold, well, you could cut the ties with gold. And that's what he did. And it was a temporary cut. They actually tried twice to revalue gold. Remember, in 1933, we went from $20 to $35. And they went from 35, and they got all the way up to, I think, $42.50, but it wasn't enough. So we, from that point on, went ahead and went to a completely fiat system. We were no longer tied to gold to check government spending. Well, what do you think the outcome has been since then?
Massive inflation of the money supply.
And as well as deficit spending by the government. So the inflation of the money supply is to support the spending of the U.S. government. And we can look here on the decades of deficits off to the left, where you can see around 1970, there's a little bit of a deficit, but after that we can see massive deficit. And then we also see it in the debt. So I have a great visual from the visual capitalist, but it's not really set up well for a PowerPoint slide, so I do have it rotated here so that we can see after World War II, we were at about 100% of our GDP in debt, but then begin to spend that down. And then we get to 1970, that's really kind of the low point. And then since then, we've been adding to government spending and government through deficit spending since then. We did have a small a bump in 2000, and we actually did have a surplus, but we're now back to 100%. We're not into a World War II scenario, and all projections are the debt is going to continue to expand. And the question is this sustainable? We have gone from a a bimetal system where we had gold and silver, but gold was defined as a dollar, to a system where the Federal Reserve was managing that, to a system where you could no longer redeem the gold as an individual system, to the point that we no longer redeem gold anywhere. There's no tie whatsoever to the gold system, and we're now 50 years out. Now, the economy has certainly grown. We certainly had technological advancement, but we've done it where we have more crises. They happen more often, but the duration isn't that long because we just cure that problem with more debt. Oftentimes, the problem was caused by too much debt,
Right.
but we solve it with additional increases in the money supply or additional debt.
Which works as long as people are willing to continue to accept the dollar, right?
Absolutely. The only real check on this system, on the ability to do it, is really the voters on how much inflation they're willing to accept. And I would say over the last 20 years, we've been in a low inflationary environment. But once again, that goes back to our 1920s thesis. Whenever the economy is growing dramatically and the amount of goods and amount of things that you could spend your money is expanding at a faster rate, you will see price inflation stay relatively small. Now, you could be misallocating capital, but you're also getting a lot more debt on the balance sheet if interest rates go up, which they will have to, or our technology progress will hit diminishing returns, so it will eventually slow. That's whenever this is going to be due. So then the question we have is, here's where we are. We don't know how long we can be here, but what is next? Are we going to go back to a gold standard, or do we have all these new crypto and we're actually leaving a fiat central bank, centrally controlled monetary system and going to a more decentralized, more market type of coin? Chris, what's your opinion on this?
I'll make a small case for Bitcoin and the crypto side, and then you can make fun of me. So we really both agree that the problem is an uncapped currency. So Bitcoin does solve that. Everyone knows there's 21 million. Other cryptos try to solve that a little bit differently with a set inflation rate. So they may say the max we can inflate this currency is 5% a year. If the treasury doesn't spend it, they burn it. That'd be a good idea for some stable coin from the US dollar where they can inflate it, but to a max percentage. I don't think that's going to happen. They don't really want to put that big of checks on themselves. So we really, for me, when I look for a store of value, it's going to be gold or Bitcoin. Mm-hmm. And gold really has that problem, a demand problem. The younger generations just do not want to buy it. It's actually down 8% on the year when you have massive inflation, but people don't believe that inflation's here to stay. Right. That's what it looks like, at least in the market. And then when it gets down to medium of exchange, say you want to send gold around the world, that's going to take you a couple weeks. While Bitcoin, you can do it in a second. That's really the bear case for Bitcoin as well, is there's a reason you can send it so quickly. You're essentially sending nothing. Mm-hmm. So gold, you're at least sending something. You're sending a block of metal. Right. Bitcoin, you're really sending nothing. So as long as that belief system is there, people will keep accepting it. So it really comes down to the belief system for Bitcoin.
Well, and the belief system is also there with gold, right? The value of gold as a utility piece is mainly jewelry or having nice, pretty things. But we know that other people will accept it, or historically have accepted it. It's thousands of years old, where Bitcoin is brand new.
Right. Bitcoin can certainly go to zero because it's nothing. But gold, you're saying unlikely. That's not going to happen. It's historically, there is a use case there as well, if there is no demand for it.
And there are things that are going on in the internet where it's talking about the crypto as a data tool or information, because this is really moving to information money. May have a use value as well. There's a lot of things where they talk about Internet 3.0, where they're using crypto, which prevents any type of censoring or any type of gatekeeping that is in the works. My take on the reason that I wouldn't say bearish, I think a lot of it's really interesting to see this monetary phenomena happen in the crypto world, is that there's still a centralized system here that has a military, and they are able to project their power and their force into the environment. And there's no reason that they wouldn't say, well, we're going to regulate these cryptocurrencies, and they're going to regulate it to a point where they can't act as a medium of exchange. So you can buy Bitcoin all day long, and the government is not upset so long as you pay your taxes on their appreciation and use it as a speculation tool. They don't care. The moment that you start doing it, treating it as a medium of exchange, There was a recent report of a Bearcat, which is kind of a civilian police tank, going through a person's house and on wire fraud. Now, I don't know the details of it, but it seems that the government takes action against people that are trying to move it to a medium of exchange so they compete currencies. And as I look at it now, none of the cryptos have a standing military. So I think central governments have an advantage in the ability to enforce what currency is there. However, their ability to enforce that and pay a military is dependent upon everyone else still seeing value in their currency. So it's not easy to pay a military in a currency that you're inflating and is becoming worthless. And this has been the fall of many empires. Not making a claim that this is where we are in the U.S., just going through the thought process. So there would be some type of check on if they are inflating the money supply too much, that their currency is becoming worthless. However, and this is why I think gold is here and will continue to play a form in the monetary system if we get into a situation where there's significant doubt on the current U.S. dollar as reserve currency, is that there's still gold out there. The governments would then say, hey, we're going to go back to this standard where we reduce and constrain our ability to spend by tying the currency back to gold, which will probably start that whole 1913 to 1971 cycle all over again. But the U.S. currencies would probably have some type of connection to, or global currencies by central banks would have some type of tie or connection to gold, and there probably would be some type of ledger accounting system so that you can avoid the problem that gold has relative to Bitcoin is, I can't send it quickly. I need to be close to you to make this trade. No one does that. That's why we got paper currencies and banking system established. So which one wins out? I don't think either one of us is saying that we're not maximalist on either one, right? We think that there is a role for both of these, as well as the international banking central bank monetary system. There probably is some type of merger of all of these over time with competing markets where decentralized currencies are competing with centralized currencies as a store of value.
And to close out, short-term expectations for these. Bitcoin is going to be extremely volatile. It historically trades like levered stocks, risky stocks. The bull case is that eventually it will be an uncorrelated asset. So far, it is a very correlated asset.
Absolutely.
While gold, as you made the case, it's historical money. Expect the volatility to be a little bit lower. A lot lower, and a lot less correlated.
And this is where I think a lot of, I even saw it in the Wall Street Journal, a misunderstanding of gold as an inflation hedge. Gold shouldn't compete with equities and stocks. It's supposed to be a store of value, not buying an investment where you expect substantial value. And if we were to look at gold whenever it was $20 an ounce and you put $20 bills and then you stack $1,700 next to it, we can see that as a store of value, gold has done a good job over time. It has not outperformed equities, but that's not its purpose. It's to act as cash that holds its value. It does that. Bitcoin as a store of value, maybe at some point. Right now it is not, because if Elon Musk tweets something about Bitcoin, there is a reaction that is quite sizable. So if one individual can move the market that much, how could that be a store of value at the moment? Nonetheless, I think there's a lot of things that are coming out of this 10, 20 years from now. We'll be seeing this and being like, well, it was completely obvious what would happen. How did we miss this? But we think there's going to be these ties that we're going to see over time. So that gets us to our themes. So we continue to see inflation risk as high. We have seen a pullback in the amount of trailing 12-month CPI on the last report, which is good. We think labor costs are probably what's going to drive inflation going forward, as well as any of the infrastructure bills, if they were to get passed, that would increase the money supply and increase the inflation risk. So right now it's still above target, but actually going the right way. We favor equities over fixed income. You just don't get compensated in bonds relative to where inflation is and is to be expected. We can continue to favor U.S. domestic equity. We actually made trades this week where we're pulling back some of our exposure in emerging markets, specifically China. We ought to do a segment on why we think China is not going to be the next superpower and that the U.S. is fading. There's a lot of problems there domestically, despite all the headlines that we're seeing in Afghanistan and the pullout of the U.S. We continue to favor technology over the long term as Bitcoin, as we technologize. I don't know what word I'm trying to come up with. The 5-month-old kept me up pretty late last night. But as we see this technological innovation hitting everything in the economy, we think technology is a place to be long term. When we look at price points, the market continues to climb. We've had a little bit of a pullback here, but not even hitting our 50-day moving average. I wouldn't be surprised to see a nice correction. We're kind of in that August, September, October.
Sentiment's pulling back a little bit. There was a dip on Monday. It got bought up pretty quickly. Dip again yesterday. Not bought up as quickly as sentiment has really changed, and everyone's coming on and saying, "Don't buy this dip." So it's just some short-term noise.
And whenever we look at our spider graph on some of the risk factors, we have a lot more in the red, and we're starting to see that in technicals. Most of our trades have moved us to large capitalized U.S. companies because they will hold up. It's not to a point that you want to be in cash. You just want to be in more defensive positions. So we are becoming more and more weighted to U.S. large cap companies as we see this go through. If we continue to see the money supply drop, which is the next slide, I'll just jump to there, we may become more and more bearish, more defensive, which could include, but not yet, raising some cash in investment accounts, especially the qualified. Still very high on the growth relative to other years, but we can see that the money supply growth is declining, and that's a big cautionary flag for us. And then when we get to our relative strength, as we mentioned, the S&P 500 is near the top. Large cap growth companies are the place to be at the moment. Or in the we added Bitcoin as something to pay attention to. Right now it's on a rally, and talking about that divergence, where gold is just not having a great year, where Bitcoin is. Now, if we do have a correction, my guess is those two will move in different directions, but yet to be determined. There's also not as much demand coming out of China and India, so there are economic reasons, not just perceptions, that there is a little bit less demand, but both of those areas are beginning to increase their consumption of gold as an investment vehicle. Meaning that it's not being created as jewelry, it's being held as a monetary substitute. And anything that you would like to add to it?
No, nothing.
So please let us know if you have any questions, and we'll have the number here if you want to contact the lead advisor, whether you're a client or someone that's watching the video and would just like a second opinion. Also, you can go to our website and click there and request to connect with us. Feel free to give us a call. We're happy to hear your take on the market or anything that we possibly could be missing, or that you think that we don't have correctly here, or just to say hi.